Hello, everyone, and welcome back to the J22 Report. I'm your host, Johnnie Market. You all know that drill. Hit that like button, subscribe if you already haven't. And just disclaimer, nothing should be construed as financial investment advice, just my thoughts on the markets. Let's get into today's stuff. Here's what I just uncovered. Market was up, gold was up, not surprising. Economic data, which, the business optimism index, 105. This is good sentiment. PPI came in less than expected at 2% instead of 3. That's month over month, year over year, 3.5%. Nothing else really. The RCM tip economic index, that was actually less than expected, but over 50 still, expansion. But economic data came good. That's why the PPI is lower. That's why the stock market's up. Lower rates, gold's up. I think gold also just recovered from yesterday, personally. What I want to get into, which I wanted to point out interesting, is you can see some sort of change in sentiment here, or market beliefs, and this is why rising bond yields are such a problem for stocks. And I talked about this is going to be the new norm. They just haven't gotten it. And I think they're preparing you, maybe, but climbing to 4.8 Monday, 5%. If you look at it right here, the 10-year trend is at a level that makes investors cautious. So 5%, once they hit over 5%, uh, and look, normally that is normal, but for one, it's not normal. This is what they say, at least in the post-financial crisis world. The reality, it is normal. If you go to before the tech bubble, interest rates were generally 5% or more. So 2.9% is the average, 2.91 over the last 2 decades, which if you look at it, that's since 2004. So that's only 4 years before the financial crisis. So yes, post '08 world, it's not normal, but and that's the real problem with this crisis is we have a whole generation of slew of people, which myself sort of included, and they're in their 40s, have never known high rates. So they have no but one of the reasons 5% this will eventually hurt stocks is that they have a similar yield to dividends. So why get a dividend risk a company when you can just park your bank and you earn 5% interest? So, and they consider it a risk-free asset, which is not. It's going to tank. But the other thing is higher borrowing cost. That's going to hurt companies when they need to refinance, and it will also hurt consumers. And it'll cause more bankruptcies. Now, remember what I said originally from 2022 when they started to raise rates, it was good because they had this cash. Their debt was locked in long term. And so they just started earning interest. And that's one reason the stock market started going up is higher rates drove it up because they had all their debt locked in a lower rate. Now, 2025, you've been paying attention. I did this videos back. You're gonna have to go back and relook if you don't know. A lot of commercial real estate is due and they're underwater. So that is something to be challenged. So obviously there's more Donald Trump, blah blah blah. I love so so uncertainty is what keeps driving yields higher, whatever. Anyway, that's all. That's for that one. And the PPI shows that, they're starting to realize because they listen to this channel, the elite, the Fed, all those people, they listen to this channel and they're starting to realize they have an inflation problem. But instead of being honest with you, it's, we cut rates and we're trying to inflate asset prices. They want to blame the Trump tariffs. Now, so anyway, PPI less than expected. But if you look at this article here, let's get rid of this. Wholesale prices rose less than expected. Markets fears that inflation, though, isn't falling as quickly as hoped. The Federal Reserve's 2%. Well, we're never going to see 2% uh, inflation again. I mean, well, we'll never see it in real terms, but in terms of the CPI, we'll probably never see it. Well, no, when the market crashes, we'll see it. So never mind, take that back. So rose 3.3% from the year, up from 3%, but below 3.5%. So, but look at this. I'm surprised mainstream mass and prices jumped in a few key components which fed directly into the Fed's core PCE. So they even said it seems encouraging, but also masks some prices. So even mainstream's starting to understand that all these personal consumption indexes, PPIs, and all these things are being masked, and they're not really, the data's not showing the true. A recent hot labor has accounted to largely believing signs of cooling inflation to come out to be required for the Fed to cut rates further, which doesn't make sense. Like, if you have inflation above the 2% mark, job markets are doing well, earnings, then you should be keeping rates as is. So they're trying to prime the pump for interest rate cuts. If you look at this, Fed rate markets don't see more than a 50% chance the Fed cuts rates at a meeting until last. So anyway, I think they're because of the refinancing, they're going to continue to cut rates. So I think the Fed will continue. So, but to show I'm right, and also, they do listen to this channel, do it covertly, but they do. They know problems. Over 1,800 CEOs resigned in 2024. The year of economic drop. I don't know what this. Look at that. They even look at that. Used AI for blonde hair. That's not blonde hair. So 1,800 CEOs have announced their retirement. So obviously they're going to make up a lot of excuses. But last time they resigned like this was during COVID, and then something happened. So if you ask me, high turnover is also attributed to growing risk. So yeah, that's why they see a iceberg and they're on the Titanic, but they have a get out of jail free card, and that's called a resignation, and that's really what it is. So anyway, more things about shows that the economy. I would love to say this means the economy's struggling, but Microsoft pauses hiring in U.S. consulting, cuts so plans. Look at this. Not to expense travel to any internal meetings, but to use remote sessions instead. Microsoft last week said it would lay off some employees. So this is why they're sucking up to Trump. They're going to lay off Americans and probably hire H-1B ones. So this is going to be bad for social cohesion, and it's going to really, I mean, it's really going to get things. If these businesses were smart, they at least pause hiring H-1B ones after considering the political discord. But we have stupid people in charge, not just in government, but in business, so they don't understand. So, and here it is, Meta announces 5% cuts in 10th year. So they're probably doing the same thing, hiring off, and that's why they're kissing up to Trump. And so that's what they're going to do. And I think they're going to probably either offshore their jobs or import the labor from another country. So more stuff if you want to know why they're kissing up. But anyway, that's all I have for you today is that's all I have. As you can see, there are problems in the economy, the record CEOs, inflation is heating up, inflation is one, and that's why CEOs are resigning. They know their businesses are going and they want to go out on top. They stay another couple years, they're not going out on top. Anyway, if you listened all the way through, thank you for listening. Hit that like button, subscribe, and I will see you next video.